Enron is the most satisfying corporate disaster in American history. A company that went from boring pipeline operator to seventh largest corporation in the country to completely, irreversibly dead in about 16 years. From fake profits to secret partnerships to executives dumping stock while employees lost everything. Today, I'm breaking down the entire history of how it all happened, starting with an origin story that nobody planned. The founding of Enron wasn't built, it was an accident. In July 1985, a Nebraska pipeline company called Internorth was desperately trying to avoid a hostile takeover from a corporate raider. Their brilliant defensive strategy? Buy someone else first. So they acquired Houston Natural Gas, creating a combined entity with roughly $2.5 billion in assets and 37,000 miles of pipeline. Then they had to name the thing. Nobody liked Internorth. Nobody liked Houston Natural Gas. So they landed on Enron, which sounds like a medication for joint pain, but was apparently derived from energy resource. Cool that Kenneth Lay, former CEO of Houston Natural Gas, took over as chairman and CEO. Lay had been pushing for natural gas deregulation since the late 1970s, and he genuinely believed a deregulated market would change everything. At this point, he wasn't wrong. He just had zero idea what his company would become once the wrong people got involved. But those wrong people were already on their way. Skilling, Fastos, and the Dream Team. In 1990, Kenneth Lay hired a McKinsey consultant named Jeffrey Skilling to run a brand new division called Enron Finance Corporation. Skilling was the big idea guy. He believed he was reinventing capitalism, and honestly, he might have been the only person on earth who found energy trading sexy. He immediately started recruiting aggressive young Wall Street traders, dangling massive compensation packages in front of anyone with a pulse and zero moral compass. Then there was Andrew Fastow, hired in 1990, CFO by 1998 at just 36 years old. Where Skilling was the visionary, Fastow was the quiet numbers guy who figured out how to get personally rich off the chaos. He designed compensation structures where he profited directly from deals he was supposed to be independently overseeing. He was essentially paying himself out of Enron's own profits through partnerships he created and controlled. Between 1997 and 2001, he pocketed roughly $45 million doing this, which is, not ideal. By February 2001, Skilling was named CEO, while Lay slid into the chairman role. The visionary and the accountant were now running the show. One thought he was a genius. The other knew exactly what he was doing. But here's the thing. The rest of the world didn't see a ticking time bomb. They saw America's most innovative company, for 6 consecutive years. From 1996 to 2001, Fortune magazine named Enron America's most innovative company. 6 years in a row. Not most profitable or fastest growing, but most innovative. Like they were Apple, except instead of inventing the iPhone, they were inventing new ways to make money disappear. And the numbers backed up the hype. At least, they seemed to. Enron stock climbed from $17 a share in 1990 to 90.75 by 2000. That's a 434% return. The company employed 21,000 people worldwide and reported revenue of $100.79 billion in 2000, making it the 7th largest corporation in America. Analysts were tripping over each other to recommend the stock. The financial press wrote love letters. Everyone was applauding the architecture of what turned out to be a house of cards. But here's the part that really stings. Fortune kept handing Enron that innovation award, even after accounting questions started surfacing in mid-2001. Analysts kept calling it a safe growth investment. Nobody in the financial media stopped to ask the one question that mattered. What exactly is this company innovate? Turns out, the answer to that question was way darker than anyone expected, because Enron wasn't just bending the rules of accounting. They were using a very specific trick to print money out of thin air. The mark-to-market trick. This is where Enron stopped being a company and started being a casino that printed its own chips. In 1991, Enron convinced the SEC to let them use something called mark-to-market accounting for their energy contracts. This method was originally designed for Wall Street securities traders. Enron used it for 20-year energy deals. Here's what that means in practice. Imagine you sell someone a promise to deliver natural gas for the next 2 decades. You don't know what gas will cost in 2011. Nobody does, but you guess. And then you book the entire estimated profit of that 20-year contract right now, today, before a single molecule molecule of gas has moved anywhere. In 2000 alone, this little trick generated roughly $1.5 billion in reported earnings from contracts that produced zero immediate cash flow. By 2001, approximately 80% of Enron's reported earnings came from mark-to-market accounting rather than actual money-changing hands. 80%. The company was essentially a giant spreadsheet of optimistic guesses wearing a suit. But here's where it gets truly beautiful in its insanity. When energy prices moved against their projections, Enron's accountants didn't adjust downward like normal humans. They just assumed even higher future prices next year to offset the losses. Guess wrong? Guess bigger. It's like losing at poker and deciding you'll win it all back because next hand you're definitely getting a royal flush. Every time. For a decade. But booking imaginary profits was only half the problem, because Enron also needed somewhere to hide the very real losses piling up behind the curtain. The secret partnerships. So Enron was already booking imaginary future profits as real money. That's bad. But what they did next makes mark-to-market look like a rounding error. Enron created approximately 3,000 special purpose entities. 3,000. That's not a company with a few shady side deals. That's a shadow corporation operating underneath the real one, with names like LIJM, Chuco, and White Wing Associates, which all sound like rejected Star Wars characters. Here's how the scheme worked. These shell companies were financed with 3% actual Enron equity and 97% debt. Enron would loan money to the SPE. The SPE would use that money to buy Enron's bad assets, and then Enron would book the sale as profit. They were literally buying their own garbage with their own money and calling it revenue. Hey, great news. Someone bought our failing power plant. Who? Us. But wearing a fake mustache. The result? Enron's actual debt was around $13 billion. But on the official balance sheet, only $3.3 billion showed up. The other $12.7 billion just vanished into the network of shell companies like it never existed. And here's the kicker. Andrew Fastow, the CFO, was personally managing several of these entities through his LJM1 and LJM2 partnerships. He earned roughly $30 million from the same deals he was supposed to be overseeing on Enron's behalf. He was the buyer and the seller. Arthur Andersen, the auditors, looked at all of this and said, yeah, looks fine. But the thing about building a house of cards out of 3,000 fake companies is that eventually someone notices the wind picking up. The cracks begin to show. In August 2001, a mid-level accountant named Sharon Watkins did something nobody at Enron had the guts to do. She wrote an anonymous letter to Kenneth Lay himself, warning that the company was about to implode in a wave of accounting scandals. She named names, she identified the mark-to-market abuses, she called out the SPE debt transfers. She basically handed leadership a detailed map of every bomb buried under the building. And what did Enron's leadership do with this information? They tried to figure out who wrote the letter. That's it. That was the plan. Not fix the fraud, not call the lawyers. Well, actually, they did call the lawyers. The lawyer's job was to find the whistleblower. Internal investigators who got too close were fired or pressured into silence, which is, not ideal. Meanwhile, journalist Bethany McLean had already published a piece in Fortune magazine asking a devastatingly simple question. How exactly does Enron make its money? Nobody had a good answer. The stock, which had peaked near $90 back in August 2000, had already slid into the mid-30s by late August 2001. Then in October, Moody's and Standard & Poor's both downgraded Enron's credit rating. The SEC launched a formal investigation on October 22nd, and almost immediately after, document shredding kicked into high gear at Arthur Andersen's offices. Watkins tried to save the company. Leadership tried to save themselves. One of those strategies had a chance of working, and they picked the other one. But if you think the slow bleed was bad, wait until you see what happened when the dam actually broke. The collapse in 24 days. On October 16, 2001, Enron restated its earnings for the previous 4 years. Turns out they'd been hiding $586 million in losses. Just a casual $500 million they forgot to mention. The stock was already sliding, but this is where the floor disappeared. On November 8th, Enron announced a $1.2 billion write-down tied directly to Fastow's SPE partnerships and his conflicts of interest. The same partnerships he'd been personally profiting from. The market responded exactly how you'd expect. Now here's where the numbers get genuinely insane. Enron's typical daily trading volume was about 5 to 10 million shares. On November 28th, that number hit 330 million. That's not a spike. That's every single person with a brokerage account hitting the sell button at the same time. The stock went from $36.80 on August 23rd to $9.18 by November 28th, a 75% collapse in under 100 days, with the worst of it concentrated into a 24-day freefall. Billions of dollars in value just evaporating in real time. And where was leadership during all of this? Well, Skilling had already resigned as CEO back on August 14th, citing personal reasons. Great timing, Jeff. Meanwhile, Kenneth Lay was on television telling investors the stock was undervalued, a bargain even. Buy the dip. He was also quietly selling approximately $80 million in personal Enron stock between January and September. So he's on camera saying everything's fine while his broker is liquidating his entire position, which is, not ideal. But the free fall hadn't even hit bottom yet, because what comes after a 75% stock collapse is somehow worse. The bankruptcy. On December 2nd, 2001, Enron filed for Chapter 11 bankruptcy, $63.4 billion in assets, the largest corporate bankruptcy in American history at that time. And just like that, 21,000 people woke up to a completely different life. About 4,500 employees lost their jobs immediately. When you factor in contractors and suppliers, that number climbs closer to 8,000. But the job losses weren't even the worst part. Here's where it gets genuinely enraging. Roughly 60% of employee 401k retirement savings were held in Enron stock, restricted Enron stock, meaning employees were explicitly prohibited from selling it. They watched their life savings evaporate in real time and couldn't do a single thing about it. Meanwhile, executives like Lay had already cashed out approximately $80 million in personal holdings months earlier. Employees lost a combined $2 billion in retirement funds. The people who built the company got nothing. The people who destroyed it walked away rich, which is, not ideal. And the creditors didn't fare much better. After 3 years of restructuring, they recovered approximately 14 cents on the dollar. The bankruptcy proceedings alone cost $750 million in legal and accounting fees. So even the process of figuring out how badly everyone got screwed was itself incredibly expensive. Great. Add that to the list. But if you think the people inside Enron were the only ones covering their tracks, wait until you hear what their auditors were doing with a paper shredder. The cover-up, Arthur Andersen. So here's the part where you find out the referee was getting paid by one of the teams. Arthur Andersen had been Enron's auditor for 16 years. They were supposed to be the independent watchdog, the firm that checks the math and tells shareholders whether the numbers are real. And for that service, Enron paid them $52 million in 2000 alone, which is, not ideal for objectivity. Andersen partner David Duncan personally signed off on the mark-to-market accounting, the SPE structures, all of it. Internal team members raised warnings. Duncan approved the schemes anyway. Because when your client is writing, you checks that large, hey, maybe this is fraud is a really inconvenient sentence to say out loud. But here's the thing. Andersen didn't discover the fraud and then cover it up. They helped build it. They enabled every accounting trick we've talked about in this video while simultaneously being paid to verify that everything was legitimate. The watchdog wasn't asleep. The watchdog was on the payroll. Then, in October 2001, right as the financial disaster was becoming public, Andersen sent out a memo reminding employees about the firm's document retention policy, which is a very polite way of saying, start shredding. Tons of documents related to Enron were destroyed. That's not a clerical mix-up. That's a coordinated bonfire. Andersen was convicted of obstruction of justice in June 2002, but the conviction almost undersells what happened. This was the auditor holding the door open, collecting enormous fees for the trouble, and then burning the evidence when the cops showed up. And if you think the legal consequences stopped at the accounting firm, wait until you hear what happened to the people who built this whole house of cards. The trials and convictions. Andrew Fastow was the first domino to fall. He pleaded guilty to 2 counts of conspiracy in January 2004, and in exchange for a reduced sentence, he agreed to testify against the 2 men he'd spent years building financial fairy tales for. His reward? 6 years. Here's where it gets interesting. Fastow's testimony became the prosecution's weapon against both Skilling and Lay. Jeffrey Skilling was indicted on 35 counts, Kenneth Lay faced 11. And on May 25, 2006, the jury came back with guilty verdicts for both of them on the same day. Skilling convicted on 19 counts, including conspiracy, fraud, and insider trading. Lay convicted on all counts across 2 separate trials. For a brief moment, it looked like justice had actually shown up to work. Then Kenneth Lay died of a heart attack on July 5, 2006, about 6 weeks after conviction, before sentencing ever happened. And because of a legal principle that says you can't punish a dead person who hasn't exhausted their appeals, his conviction was vacated, completely erased. Legally, it's as if it never happened. I don't know what to tell you. Skilling got 24 years, later reduced to 14 after a Supreme Court ruling narrowed the scope of the fraud statute he'd been convicted under. Not exactly a ringing endorsement of how clean the original case was. In total, over 20 people were convicted or pleaded guilty in connection with Enron, but critics point out that mid-level employees often got harsher treatment than some of the executives who actually designed the fraud, which is, not ideal. But if the convictions feel incomplete, wait until you see what Enron's collapse actually changed about American law forever. The fallout and the Sarbanes-Oxley Act. Enron didn't just destroy itself, it rewrote the rules for every public company in America. On July 30th, 2002, President George W. Bush signed the Sarbanes-Oxley Act into law, and nobody was subtle about why. Enron was cited by name during the congressional debates. The message was clear: this will never happen again. Section 302 forced CEOs and CFOs to personally certify their financial statements under penalty of criminal prosecution. No more I didn't know. Section 906 created penalties of up to 20 years in prison for executives who knowingly falsify financial documents. Section 404 required auditors to actually test internal controls, which increased audit costs by roughly 40 to 50% for large companies. And the act created the Public Company Accounting Oversight Board, permanently ending the auditing profession's cozy little tradition of regulating itself. So, problem solved, right? WorldCom had already collapsed before the ink was even dry. Tyco's executives were getting hauled into court for looting their own company. Then, the entire mortgage industry collapsed and nearly took the global economy with it. Turns out, making executives personally sign a piece of paper saying, "I promise I'm not lying," does make them more cautious. It does not, however, make them honest. Sarbanes-Oxley changed the rules. It did not change the game. Corporate fraud isn't a bug in the system. It might just be a feature. And every few years, we get to act surprised about it all over again. If you enjoyed this video and want to see more, click the video on the screen now.